This is IA Forward, your playbook for success as an independent insurance agent. Now, here to help you knock it out of the ballpark are your hosts, Shane Tatum, Tanya Lead, Mike Basil, and Robbie Jabor.
Welcome to IA Forward, and welcome to part 2 of our podcast on how to make your contingency bonuses be as prolific as possible. Because last week, this was the topic we started on, and shocker, we got off on some tangents, and we never actually answered the initial question, which was, what can we do to make sure that those bonus checks are as large as possible?
Well, that's fantastic. That's a great topic.
It is also so much confidence in Shane and I to remember what we did last week.
That's what I'm thinking. Like, what? Like, I don't remember what I did at 8:00 this morning. Like, that was only a couple hours ago. So that's why it's a 4-cup coffee morning for me this morning. So,
wow, it's a caffeine connect kind of day.
It is. So it's that's bad. But so hey, we'll give it a shot. How about that?
Yes. So Shane, what can we do to make our 2026 profit sharing checks be amazing in the last 9 months of this year?
Yeah. So 2026, but in results, right? So money that you're going to receive in the spring of 2027, in most cases, you can't do anything. You're done. It's too late.
Well, isn't that delightful? I mean, well, folks, that has been the podcast. As Shane would say, attitude's a choice.
I am being a little bit sarcastic. I mean,
I don't think you are.
Well, okay. So yes and no. So let me explain myself. You can do things, right? But I think the word you used, which is a great word, and I think it's true, was prolific. How can you help your profit sharing, your contingency dollars be the most prolific as possible, right? I think that's a great thing that agency owners need to be thinking about. And the sort of tongue-in-cheek statement that I am making of, well, can't really do anything. What I want everybody to understand is the insurance business, the insurance agency business, is such a long tail business. Okay. And so what I mean by that is that in order to really, really affect 2026 results, you needed to be really working on things in the spring of beginning of 2025. Right. And I know that sounds like, well, wait a minute. I thought profit sharing and contingency dollars were year to year, and they are for the most part, right? They are. And so what you're really doing is if you haven't ever paid attention to it, if you haven't ever really focused on it, you're starting now. It's always now. Start as soon as you can. Pay attention to it as soon as you can. What I want everyone to be realistic about is that because of the long tail, that you might see some gain by being disciplined with a few things that we can talk about through the rest of 2026 that will give you better 2026 results. But the work you put in right now through the end of 26 is really about carrying that through into 27 for your payouts in 28. And then having that cycle perpetual, right? You want to have that cycle perpetual, with the exception of the reality that sometimes we have catastrophe losses in certain years that are higher than others. Okay. And so when I say that a little bit on tongue in cheek, is you can't really do anything, that's not really true. What I don't want you to do is set this false expectation is if you work on your retention, if you work on growth, and you can't really work on growth without retention. If you do all these things and you increase your policy per customer and all of those things that are related to this, I don't want you to be disappointed if the uptick, if the increase or the payout as a result of 26 isn't just crazy drastic, right? Because what you're doing is you're laying foundation. You're creating foundation that allows you to perpetually get better and better every year. And it's not just a 1-year plan that you've got to create.
So in that, you mentioned a few things, number of policies per customer, things like that. But one thing you did not mention was remarketing.
Yeah.
Why didn't you say remarketing?
Well, remarketing doesn't make anybody any money, number one. And it should be the last option, right? It should be, and we've been dealing with that for the last several years in the hard market where remarketing became a necessity. Remarketing became something that you had to do to retain a client. But remarketing doesn't make you more money. It doesn't make the carrier money. It actually costs you money because you're taking a piece of business, right? A client.
Yeah, let's define it.
All right. So you're taking a client, you're taking a policy, revenue. And in your mind as an independent agency, especially those that came over from the exclusive agency system, it's like, well, I got to constantly find them the best price. Well, what happens is that the only people that you can truly remarket are the people that have claims problems, the people that have other issues. And then you end up creating loss ratio problems within the book because you're never allowing that earned premium to mature. You're never allowing the underwriting process to take place, right? If you're constantly churning business from book A to book B to book C and back and forth, you're spending a lot of energy on revenue you already have, okay, which is not the name of the game in the insurance industry. You want to retain the revenue you have with the lowest possible cost structure, right? So that's just something that is really important. Well, if you're touching every renewal because you're having to remarket, requote, rewrite everything you have, you're spending money on existing revenue. You're not spending dollars on new revenue when you're doing that. And so the whole thought process is in the choice system. Everybody perceives that in the choice system, the independent model, that you should constantly be remarketing business and moving business from carrier to carrier. That is not the way you become successful in the independent agency system. The way you become successful is you write business, you grow books of business within carriers, and you stabilize those books, and you, yes, use the remarketing tool when it's necessity, but it should be a really small percentage of your book that you're doing that with on a year-to-year basis.
It's an opportunity cost, really, because you're working through the same customer you already have, and that is time you could be putting towards a prospect.
Well, and yes, and then it's a people cost issue for us in the insurance industry. I mean, 60% of our expenses on average are people, labor. And if you remarket everything, then you have to have more people. You have to have people to do that unless you don't sell anything new. And that's now we're going backwards, right? Because we know even the best agencies are losing 7 to 10% of their business through natural attrition every year. A 90% retention rate is fantastic. So if we're losing 10% of our business naturally, we've got to write enough business to grow, right? If we want to grow 10%, we have to account for the fact that we're going to lose 10% as well. And so again, the higher we can retain and push that number up, well, that's the fallacy is that remarketing is the answer for that. And that's not true.
I just want to go back to something you just said and point this out. Do you know how phenomenal it is that we have a 10% attrition ratio? I mean, like from a sales perspective, that's incredible. I mean, like in most businesses, you're looking at, keeping maybe 60% of your customers, right? And so just looking at us as a model, like Shane always says, the independent agency model is the best model in the world. And I just wanted to stop on that, but had a little squirrel moment. Do they have squirrel moments in other part of the country, or do they call them other things, like where they don't have squirrels?
I don't know the answer to that because I use that term, but I have also worked with people in the South for 20 years. So I don't know.
It's definitely a squirrel moment in Texas. And, I mean, that's definitely a true statement. We have squirrels everywhere. It's Disney in our yard every morning. And so,
here too. They're murdering my palm trees, by the way.
Well, yeah.
The squirrels
it wasn't always
in Florida are different squirrels than the squirrels in Louisiana and Texas. I mean, they are
fever? What is happening?
They are the most destructive. In fact, like if you see the exterminator billboards around town, they have squirrels on them.
Yeah. No. Well, an 8-year-old Emma Kate took care of the squirrels. She was chasing them out with her BB gun, and that was kind of funny because I had like the little, my youngest daughter was basically the little boy when she was 8, and she was running around outside shooting at squirrels with her BB gun. It wasn't doing any good. I mean, she couldn't. Number one, she wasn't hitting any. Number two, it wasn't going to hurt them if she did hit them. And so, but she was chasing them, right? She was chasing them from the yard. And since that's been 15 years ago, our front yard, our backyard looks like a Disney movie every morning because there's 20 to 30 squirrels everywhere, but they don't tear stuff up. That's kind of weird.
Yeah. Like all of my furniture by my pool, like my pretty chairs and stuff, they have eaten. Because I actually almost called one of y'all last week because the cute boy was out of town for 10 days. And I heard this noise right outside of my office. And I had actually had one of those little things all in the cold.
Now, are we sure that you don't have woodpeckers and giant rats?
No, they're squirrels. I mean, I know what squirrels
are they really squirrels?
Yeah, they are really squirrels, and they eat
I think
everything.
They're in the same family, but that doesn't feel right. Like squirrels eating furniture doesn't feel right.
I will send you pictures. I will send you my palm trees.
Yeah, that's some sort of genetically engineered squirrel.
Y'all have got something going on. This is another country has dropped. This is some type of like counter intelligence thing going on in the panhandle over there.
This is one more reason that homeowners insurance is high in the state of Florida because we have killer squirrels. But I had one fall in the pool last week. And the cute boy was like in meetings, and I don't know what to do about a squirrel in the pool. So anyway, that was most unfortunate.
Yeah.
Mike is trying to
admit me. Claim that your foundation damage was due to some sort of hybrid squirrel.
No, but our neighbors behind us had foundation damage due to their pet tortoise.
Oh.
Well, that I can see. Those things have some bite force.
Yeah.
So, but anyway, back to profit sharing.
I just want to point out
our squirrel moment.
I just want to point out that distraction moment was brought to you by Tanya and not Mike and Shane. So
it was. I accept full responsibility for that. But anyway, I digress, and I do apologize for that. And I have no idea where the squirrel moment was leading to. But the one thing I can see that might make a difference is watching how many carriers that we're writing with and making sure that just because we're losing one or two to a new carrier, a different carrier, a random carrier, that doesn't necessarily mean we have to change our entire way of doing business because something happened.
Yeah. And this is a classic problem. It's a classic problem in the channel, in the independent agency system, because we're salespeople, we're competitive, and we don't like to lose business, right? Number one, we don't like to lose. And a lot of competitive mindsets, you can ask, what do you like more? Do you like to win, or do you hate to lose? And there's just a lot of that. There's a lot of split there. And there's a lot of salespeople, agents that would probably say they hate to lose. And so losing something actually hurts more than winning something helps, as far as the mentality in a lot of cases. And a lot of times what happens is to Tanya's point, you lose a client to somebody, right? Some market that you think you now need. And you go out and you get that market, and because you had one client that you lost, instead of having this like really important view from an ownership chair of, okay, now wait a minute, is that a pattern or is that an anomaly? And, obviously looking at patterns is important. Understanding when a pattern develops is important, but a single loss of a client or even a couple of clients is not a reason to go out and pick up a new carrier. The reality is that when you have too many carriers, you're hurting your contingency and profit sharing dollars as an agency, as an organization, because there's tables and there's the more premium you write within the certain carriers. The reality of it is earned premium that's going to give you a better chance at a better loss ratio, which is also going to trigger a higher payout by percentage. And so, getting spread thin across our book of business and say, having, if I asked an agent, would you like to have profit sharing qualifications across 8 carriers or 4 carriers with the same size book? What do you think the right answer might be? And most will say 8, right? Most will say 8. I'm going to say 4. And I'm using that analogy not because 4 is a perfect number. I'm just using it, right? The reason that I think 4 is better is because if you quote qualify across 8, that means you spread things out to the point that you could have really gone in and partnered with 4 carriers. You could have grown that book of business within those 4 or 5 carriers, and you are qualifying at a higher level at that point, right? And so the dollars, it's just math. It works out, right? If you have a qualification measurement of, say, $500,000 in premium for a single carrier, and you get to $500,000 across 8 carriers, right? Or you get to $1 million across 4 carriers, your book is the same, but your payouts are going to be higher at the 4 carriers versus the 8 carriers, because your percentages are going to be higher because you have more volume with them.
But here's the thing, right? If you join a group, you can kind of split the difference, because you don't need to have as much volume per carrier to hit those thresholds.
If your group offers profit sharing,
If you're
like the Integra Partner Network,
Right.
shameless self-promotion.
Yeah. If it does, and yes, that's true. If the group offers profit sharing, but in your group, and I'll take Mike's, I'm going to take that debate for a second because I think it's valuable. Technically, yes, right? The group is qualifying at a higher level. However, if the group has a payout level, right? Like, based on you can qualify for more based on either volume or loss ratio components. It's my argument that the more volume you have with a carrier, the better loss ratio potential over the long haul you're going to have as that book of business matures. Because look, carriers don't renew business year in and year out if that business is not profitable. Okay. They don't renew business just to renew business. They renew it because it's working, right? And as somebody that has a high claims activity, incidents, bad driving record, etc., they're eventually going to be non-renewed. You're going to have to move that client to somebody else that will take it. As that business that's having claims problems migrates somewhere else, and you've continued to partner and grow with that carrier, the natural thing that happens is your loss ratio should go down. Well, in our case, in our group, we reward better loss ratios, improved lower loss ratios over time. We've aligned what we're saying with the payout potential. And so you can actually earn more by having a growing, stable book of business instead of, again, spreading things too far. And look, this is going to put some people into some PTSD because of the last 3 years, because they're like, well, my gosh, Shane, if you're telling me that I need to only, really write business with, 4 or 5 carriers, well, 2 of those carriers stopped writing business altogether, 2 years ago during the hard market. It's true. That's a true statement. What I want to make sure that agents understand, especially agents who have only been in the channel for about 10 years now or less than 10 years, is that cycle we went through, right? That cycle happens probably once a decade. And that cycle was the worst cycle since at least the 80s. So let's go back and say 4 decades, right? So out of the hard market cycles that come and go, and it's just it's a cycle, right? That's why they call it a cycle. Is things go hard, they go soft, they go back to hard. This is a long period of time. And in between, yes, you may have these situations where things get a little difficult when you have a smaller carrier portfolio over a larger carrier portfolio. My contention is that your efficiency gains, your profit sharing payouts, your operating profit potential will always be better with a smaller portfolio over a large portfolio.
One of the things that our listeners may not know is when I initially came to work for Integra, the first thing that Shane had me do was this really interesting 9-month study of our partner agencies and then some agencies outside of our group. And we looked at agents that were our really fast growing agencies, our really profitable agencies, some agencies that were newer, that were in a growth process, some agencies that had been with us for a while, maybe a little bit stagnant, and what they did similarly and what they did differently in looking at our agents, other agents. And one of the things that we discovered really quickly was that our agents that were super successful and had been super successful long term, and our newer agents that were successful were using a smaller number of carriers, and they weren't remarketing every time there was a renewal. Our agents that had the thought process of, well, it is my job as an independent agent to make sure that my clients have the least expensive rates possible. And or they use the word cheap on the sign out in front of their building. Those were the agents that really and truly weren't growing at the rate either they wanted to grow at or at the rate that others were growing at, right? And since that project happened 8 to 9 years ago, I still pay attention to that, right? And I still see those same patterns.
It's a true pattern. It's a pattern that's going to be there. It's going to stand the test of time. Like even efficiencies like AI, they're not going to change this situation, right? This question. It's a perception issue, right? It's a perception issue because as an independent agent, as a choice model, this sort of unlimited number of carriers idea, this concept of, 50 carriers, 100 carriers. Number one, it's a marketing ploy by aggregators, networks that are just selling that model, right? It's a marketing ploy. It's not real. It's not true. It doesn't work. It just gets you to be interested in their market access model. The truth of it is that it's about a competitive portfolio. It's enough markets to have choice, but not too many markets that kills your efficiency, right? And this is the thing. Yes, independent agencies are started, owned, and operated by salespeople. But you have to shift at some point. You're no longer just a salesperson, right? It's not about just making a sale. It's about making sales and growing a book and running a profitable venture, profitable business. So you have to think about things like operating margins and efficiencies and what does this book of business look like 5 years from now, 8 years from now? Because this whole adage of, the whole thing about the insurance agent through, I don't know, 60 years, 80 years, some number of really long time, is that insurance agents worked really hard for the first 5 years of their life and then they got to play golf, right? That's the old adage. That's the perception. It's not, though, that far off. Maybe it's not go play golf or go fishing, but it is this. How you build your book of business, in the beginning, and what you want your book to look like 5, 8, 10 years down the road can create an easier life for yourself as an owner than finding the cheapest insurance for your client every single time the policy expires.
So this is off topic, like we like to do. And we've already talked about this, but this all goes back to who you are as the agent to this person. And there's only so many insurance carriers that are available for you to market. Everybody's going to have a similar book of carriers, portfolio of carriers. So you have to differentiate by something other than price. You have to be consultative. You have to have that person be comfortable with you. Talk to them about things outside of insurance so they know who you are and what you're about. And then they'll be more confident in you when you give them a quote that maybe isn't exactly the same in terms of dollars and cents as the person down the street.
Yeah, that's right. And I think that's a great point. Over the last 20 years, for sure, 15 even, the prevalence of the agency network, we're part of that, has created a more level playing field between small agencies, startup agencies, and, third and fourth generation agencies across the country. 40 years ago, certainly even 30 years ago, when I started in the business, agents were protected. They had sort of this moat around them, around which carriers they had access to, right? Having access to a certain carrier that your competitor down the street couldn't get a contract with because you had a contract with them, because that was the way the carriers saw things. They saw things through this lens of, well, we've already got an agent in that area. We're not going to give a contract to another agent. Well, the agency network model obliterated that. Basically, startup agencies can now get a portfolio of carriers to compete with extremely large agencies, right? And I think it's been wonderful for the consumer. I think it's been wonderful for the industry, right? Because we were headed down this path where, as consolidation was going to happen, and it did, that the insurance industry, the independent agency channel, was going to go from about 36,000 agencies across the country down to potentially less than 10,000 across the country, which was going to be terrible for independent agency carriers, which is why the agency network model started taking off and happening is because all of this consolidation that was happening with the big boys and the big agencies that had those moats, those carrier contracts that were protecting them. Well, now all these startup agencies over the last 15 to 20 years, all the way to this day, you know, we've got guys right now in startup onboarding mode. We continue to perpetuate this. It became a perpetuation process for the industry, for the channel. That became really important because now Travelers and Liberty and Hartford and Progressive and now the Geicos of the world, now they're seeing that we are perpetuating distribution and they're continuing to grow and we're continuing to take market share. And so this is a really important thing that has led us to this place. Now, what we have to be careful of is that we don't spread ourselves so thin as independent agencies that we leave dollars on the table, right? We leave dollars on the table by not being efficient with our portfolios, by not partnering with the right carriers that are going to drive additional dollars to us or points of commission to us because we are driving results for them. And you do control that. I know you don't control hurricanes coming in the Gulf and convection storms in the Midwest or anywhere or hail. We don't control that. We can't control the weather. What we can control is who we're partnering with and how we're partnering with those carriers.
Okay, I want to ask a question, and I'm going to try my best not to step on toes when I ask this question. So,
This is exciting.
Just step on the toes.
you just gave a list of carriers,
Yep.
right?
Top of mind, big brands.
Right.
Yeah.
One of those carriers does not offer profit sharing.
They're
That
working
same
on it.
carrier, yet.
They're working on it.
They're
That's
working on it.
Yeah.
But right now, that particular market does not offer profit sharing.
Mhm.
So does it make sense if it is $5, $10, $15 less expensive that if I have another carrier that's close that I have a long-term relationship with that does offer profit sharing, do I give my client the cheapest product? And I just use the C word, which y'all know that I can't stand. Or do I go with my carrier that I know, I trust, that offers me profit sharing? Which one's better for my client? Which one's better for me?
Yeah. I mean, this was the whole argument that predates, you guys being in the industry back in the early mid 2000s with Elliot Spitzer in New York. His argument of charges and prosecution was that contingency dollars were driving where brokers were placing business versus what was best for the consumer, right? So one of the problems with his argument, though, was that there was no actual real evidence that brokers were not providing the best option to the customer when it was all said and done. There truly wasn't that, right? And I think what was naturally going to happen and what did happen, I think it's going to happen again when you have new entrants into the marketplace. They're just trying to get into the market. They feel like they're behind in any carrier, right? Any carrier that's traditionally been in another channel exclusively that launches into a new channel, whether that be a direct, captive carrier that goes direct, a direct carrier that goes into the independent channel, whatever, it doesn't matter. I'm a proponent that the marketplace is going to take care of that, right? Like what's going to happen is, yes, ultimately agents are going to place business with the carrier that's best for their client. But when all things are even and equal, they're going to place that business with that carrier that maybe is more partnered with them. And I will say it that way. If a carrier is coming to the table with profit sharing or bonus dollars, then they're partnering with agencies, right? If a carrier is not coming to the table with profit sharing or bonus dollars, then that carrier, that market is I'm not necessarily saying that they're really partnering yet, right? It's almost like having your toe in the water. What will happen is if they do that for too long, right? It's like if they do it for too long, the marketplace is going to adversely select against them, and their results are not going to be what they could be. And my case in point is, when a new market comes into the channel, whether it was a direct market like, InsurTech, like a Lemonade, or, now Geico's coming into the IA channel, like it doesn't really matter in the sense of who or what, but the new kid in town's going to get the shiny object effect, and they're going to get a lot of attention. And the funny analogy that's coming into my mind is here in East Texas, I've talked about it a lot. We're in a small town. We don't have restaurants, but we're a bedroom community. That's what we call suburbs. If it's not really a city, we call them a bedroom community. And so we're a bedroom community to a town of about 50,000 people. That's, quote, the largest city in our area. There's restaurants there. All right. And they're pretty much the same restaurants, right? I mean, there's the chains, there's a few local places. When a new restaurant comes in to Lufkin, Texas, the entire county tries to get in the front door of that restaurant on opening day. I do not know why. I do not know why this is. Tanya has experienced this more than likely in Monroe, West Monroe, or even...
I experienced it at Raising Cane's in Lufkin.
All right.
I was there when the Raising Cane's opened, which is, one of my favorite restaurants. And we're finally getting one in Pensacola, thank goodness. But it was insane. Like it's chicken, and it's my favorite chicken. Like I am a Raising Cane's kind of girl.
It's
for 2 weeks.
It's overrated.
It's
Whatever.
not overrated.
It's not overrated.
Look, for 2 weeks, Raising Cane's in Lufkin looked like any Chick-fil-A, right?
They had police.
It was crazy. It was nuts, right? But that's what happened. Now, you can go to Raising Cane's today, very successful in Lufkin, Texas, and it's just go get your chicken, right? It's fine. There's not police escorting cars and security and all that. But if we open up another Raising Cane's on the other side of Lufkin, the same thing's going to happen, right? Because it's the new kid in town or the new kid in that part of town. This is what happens in our channel. The new kid comes to the table. Now everybody wants them. Distribution, something new. They're afraid to say no to the distribution. They bring them in. The network generally gets first because they get the appointment first because they can provide some immediate distribution for the that new carrier that's coming into the market, and everybody's happy at first, but over time, if you're trying to play in the same space where everyone has profit sharing or bonus dollars available, and you're the new kid in town that doesn't, eventually that's going to hurt you. You're going to eventually end up in an adversely selected environment. Your book of business is going to perform at a less desirable level, right? Because your front end salespeople are not being motivated in the same manner as the marketplace is motivating them, right? And so unless you're a unique model, right? Like you're the only true cat available homeowners market in, on the Gulf Coast, that's a unique model, and you can probably get away with it for a while until someone else comes in and competes with you, right? And so we've seen all this. This is stuff we've seen over the last 5, maybe up to 8 years. That's kind of new. It's kind of new because this, carriers didn't move from the captive channel to the independent channel or the direct channel to the independent channel. And now everyone's trying to get a piece of the independent agency channel pie. and I love it because obviously I'm a champion proponent of the independent agency channel. I think it's the best channel. I think it's the channel that's going to win in the end when other channels are suffering and struggling. But that's just what happens. And we have to have this. It's kind of why I said you can't really solve your 2026 results starting in 2026. What I really mean by that is it's such a long tail cycle of an industry that you have to think about it long term, which is why we say play the infinite game with your agency.
But isn't the answer to the part of the question that Tanya asked pertaining to the client a little more complicated? Because you're talking about, okay, maybe the dollars are slightly different, but the chances that the coverage and everything within are going to be identical between the two is probably fairly slim. There's always going to be some little difference between carrier A and carrier B. Couldn't that make a difference to the customer?
Possibly, right? Depends on the agent, depends on the client. But yes, there's some possibilities to that. I think, an agent's not going to naturally sit there in a sales transaction. I've never seen this. And this was the reason that the whole Elliot Spitzer thing blew up and didn't do what it needed to do or what he intended for it to do. It became this sort of political sham thing that was going on. But the argument that blew up on him was that agents were doing something, they were choosing the carriers with the contingency payments versus this other
just
carrier.
Like pharmaceutical sales.
Just like
doctors were
right.
because of trips and all such things. Okay.
Right. Sales, I've never met an agent, number one, that was so top of mind about that they decided that they were going to play, they're not sitting there going, okay, carrier A, B, and C, and carrier B doesn't have profit sharing, go with A or C, right? They're looking at this like, okay, what's my best option? And we can say price, it shouldn't be about price, but a lot of salespeople, at the end of the day, if they offer something that's $30 more than an option they have on the table, they're worried in the back of their mind that they're going to get undercut by another agent who offers that $30 less option, right? And so, it truly has to be apples to apples. Coverage has to be apples to apples, to Mike's point. I just think it's such a small percentage of the time that agents don't think about it. Now, when they think about it, it's kind of back to my argument, is a year down the road when the profit sharing dollars are coming out and they're looking at this one carrier that they wrote $750,000 worth of premium with that's not offering profit sharing, and they wrote, $500,000 with carrier A and $800,000 with carrier B that do offer profit sharing. And then they start to think, if I could have got an extra 2 points off of that $750,000, that's $15,000 I'm missing. So it's not during the sale. It's the, oh crap, down the road, what did I do that happens? That's where I see it generally go. And then that's where I say the market kind of takes care of it and the adverse selection takes care of it, because then that carrier's sitting there going, hey, we got to get this bonus program out the door or we're going to start losing what we've built. So they can't sit on their laurels too long.
And I want to go back to thinking about Brian Besh, Techstar Integra down in Austin-ish area. And he is the ultimate insurance advisor. There's nothing about, he would not consider him a salesperson, but he's the quintessential salesperson because he's so good at what he does, right? But he's the best insurance advisor that I've ever met. And shout out to Brian. And I know lots of good ones, so I hope nobody gets offended by that. But the idea that I would say to Brian, but this guy over here is $30 cheaper. Brian's going to be like, okay, please go over there. Right. I mean, like, he's not, because he sees himself at the same level as a CPA, as an attorney. In fact, if one of his clients needs a CPA or an attorney, they call Brian to find out who to use. Right. Because he's such a connector. He truly understands that he is helping people protect their most valuable assets. And he does a fantastic job of explaining that to his clients. And I've seen Brian sell things that were significantly more than what anybody else was offering, because he explained what he was selling to them. It wasn't, I'm going to get you a quote and I'm going to send it to you. It's this is how I'm protecting your assets. This is how I'm protecting you. This is what could happen if you go with someone else. And I hear people that are listening to this podcast saying, I don't have time to do that, or my clients don't have time to listen to that. They just want to get the cheapest price. That's our fault.
Sure.
Right? That's totally our fault. And to go with the new State Farm commercials, with the horrible 80s rock music, again, making fun of the independent agents, right? There's a reason that they chose that. And there's a reason that they're presenting themselves as advisors, as opposed to the cheesy, I'm going to get you the best price.
That's right.
Thing.
That's right.
Well, look, you're going to lose 10% of your business every year, right? Make it the 10% that's a problem.
Yeah. That's right. And,
right.
And that's really what should happen, right? And I would even say, like, when you have somebody like Brian, that would Techstar, he's training his people to emulate, his vision on that and what he expects. And he's raised the bar really high in his agency. And here's the true evidence of that. 3.5, 4 years ago, when really kind of the early signs of the hard market and inflationary cycle that we were about to head into, Brian's policy per customer ratio was 2.52. Now, let me just explain this for a second, right? So in order to get your policy per customer ratio, share of wallet, that's kind of a measurement we use internally. Our magic number that we push people, best practice, is above 2.0, because what that says is, on average, you write an auto and a home policy for your clients, right? To get to 2.52 across, 500, 600 clients, 1,000 clients, that takes a lot of things, because, there may be situations why maybe they own a company vehicle, they don't have any personal vehicles, whatever, right? Maybe they don't have insurable 2.5 insurable things. So you're writing some 4 policies, some 5 policy accounts. You're writing a lot of 2 policy accounts. In order to get to that 2.52, you're writing several accounts of 3 or more policies in your book of business. Over the course of the hard market, I just saw this a few days ago, Brian has increased his policy per customer ratio to 2.61. So during the market cycle that everybody was panicking and saying, we got to remarket all of our business. And I'm not saying Brian didn't. He did. He had to remarket some business. There were some carriers having to get off of some business. There was carriers having to get back to profitability. It had to happen. But he did it while increasing his policy per customer ratio. Okay. That has been tremendous for his profitability, and his profit sharing dollars are growing because of that book of business that he has built with an intentional mindset to not have a lot of operational costs tied to it. He doesn't have billing questions. He doesn't have a bunch of vehicle changes. I know that's crazy, but like his customers don't change vehicles every 3 months. People that they might change a couple of years, they may not change but once every 5 years, but he's not doing a bunch of churning of auto endorsements, or they don't lose their ID card, right? These customers that he's writing, that's getting him to this policy per client ratio, they're great customers, right? And he's been so intentional about that. Sometimes I think we get so wrapped up about we are a sales organization, independent agencies are sales organizations, that we do forget that the profitability of the client to our agency is a really important thing to think about.
Well, thank y'all so much for listening to the second episode on profit sharing. I hope this really helped. Planning for this year and starting this year, planning for next year, because we love mailbox money.
I think it's important that we do plan. And I know I started out with you couldn't do anything. No, you can. You can work on your book. You can, yes, work on your sales. Obviously, it's a given that we want to sell new business. We should be selling a stable, significant amount of new business every month. We should be doing that. But we should be looking at our book of business and making sure that our partnerships with our carriers are aligned really well and have some intentionality. And if you've got business spread across 10 or 12 carriers, think about what a consolidation to 4 or 5 might look like. You know, if it brings you an extra 2 points annually on, you know, say 5 million in premium, just to take just some average across like our network, that's $100,000 a year that you're leaving on the table if you're not thinking about contingency profit sharing dollars as a business owner.
Follow up to the squirrel thing. I'm thinking about Emicate, and since she is doing an internship with us this semester, do you think that I could bring her in for a week or two and let her get rid of some squirrels on our property?
I'm sure she would. I don't know. She may have to channel her 8-year-old self. I don't know if she's how much.
She hang out at the beach, come back, get some, take care of the squirrels.
You did get the net out and fish that one out, right?
Yes, I did. Yes, I did. That's exactly
I
what
wish
I ended up doing.
I wish I had a video of you trying to get the squirrel out of the net once you got it out of the.
That's a good point.
Oh no, I just turned it over
and ran for your life.
I opened the garbage can, I turned it over, I closed the garbage can.
Gotcha. Wow. That's good.
I'm going to leave us today with this quote from Tony Dungy. Consistency is what transforms average into excellence.
Attitude to choice. Make a great one.
Bye, y'all.
At the Integra Partner Network, we understand that carrier access is the key to your agency's success. That's why Integra offers direct access to top-rated personal and commercial carriers, ensuring your agency thrives in today's challenging market. And with our comprehensive resources, profit sharing and bonus opportunities, technology and peer support, all while you retain 100% of your book with no penalties to exit. Integra is ready to empower you and your agency to find sustained growth. Find your way to Integra. Visit IntegraPartnerNetwork.com today. That's IntegraPartnerNetwork.com.